3 undervalued technology stocks to buy now despite the stock market feeling the heat as macroeconomic and sociopolitical uncertainty and worries over U.S.-Canada trade tariffs weigh on investor sentiment. With volatility on the rise, the recent sell-off has pushed several high-quality tech stocks into undervalued territory, creating a potential buying opportunity for those with a long-term outlook. However, it seems that traditional rules and market history don't matter at present. Despite a bull market in 2023 and 2024, value investors hunting for a good bargain can still find some undervalued companies on sale. An undervalued company is one that is consistently profitable and has attractive long-term growth prospects. Its share price is also cheap compared to many of its peers and cheap compared to the amount of future profit expected to be generated. Such stocks can be great options for patient buy-and-hold investors waiting for hidden bargains. Due to market pressure, certain companies with strong fundamentals remain well-positioned for future growth. Now trading at attractive discounted levels, these stocks offer investors a chance to buy and hold for significant upside potential. Against this background, investors are always on alert for a good deal. It's important to remember that some stocks are cheap for a reason. A company may be cheap because its growth prospects have diminished, it's losing money, or it's losing business to new competitors. Therefore, stocks like these, sometimes called value traps, are not considered undervalued even if they trade at very low prices. Here are my top 3 undervalued technology stocks to buy right now. But before going further, please support this channel by helping us get 500 likes for this video, share, and tap the subscribe button if you are yet to. This will give the channel more visibility. Thank you. Starting with a company with impressive growth over the years. Gauzy stock, ticker GSY. This company provides non-prime leasing and lending services under the Easy Home, Easy Financial, and LendCare brands to consumers in Canada. The company operates through 2 segments, Easy Financial and Easy Home. It offers unsecured and secured installment loans, home equity secured installment loans, automotive vehicle financing, and loans to finance the purchase of retail goods, power sports and recreational vehicles, home improvement projects, and healthcare-related products and services. Stocks of the Canadian subprime lender Gauzy look highly attractive near the current price levels. The financial services company is growing rapidly, delivering double-digit top and bottom-line growth over the past several years. Additionally, Gauzy has a track record of consistently increasing its dividends over the last 11 years, making it a compelling income stock. Despite these strong fundamentals, the stock is undervalued, representing a buying opportunity. Over the past 5 years, Gauzy's top line increased at a compound annual growth rate, CAGR, of over 20%. Meanwhile, its earnings per share EPS sports the CAGR of 28% during the same period. Thanks to its impressive financials, Gauzy stock has gained over 240%, growing at a CAGR of 27.7% during this period. Recently, Gauzy stock has experienced a modest pullback, down approximately 10.7% year-to-date. This decline has positioned the stock with an attractive next 12-month NTM price-to-earnings (PE) ratio of 7.5, well below its historical average. This valuation appears particularly compelling given Gauzy's double-digit earnings growth rate, a solid dividend yield of 3.9%, and a return on equity (ROE) exceeding 26%. While Gauzy stock is undervalued, the company is poised to deliver solid growth. The financial services company will benefit from its leadership in Canada's non-prime lending sector. Moreover, its expanding consumer loan portfolio and solid credit underwriting capabilities augur well for future earnings and dividend growth. Overall, Gauzy will likely deliver solid financial performance, driving its stock price higher. The next stock on the list is Broadcom Incorporated, ticker Broadcom. The new U.S. administration's volatile tariff policies and a slowdown in AI-related enthusiasm took a toll on the market over the past few weeks. However, some analysts believe a rebound is due. Fundstrat's Tom Lee said in the latest program on CNBC that he believes the U.S. stock market will begin to recover starting April 2nd. More Insight's Patrick Moorhead said in a latest program on CNBC that unlike NVIDIA and AMD, Broadcom Incorporated was able to give a strong guidance that catapulted its stock. Here is what he said. What Broadcom did that NVIDIA and AMD didn't do is give a very rosy forecast, one that was beyond what anyone else would expect. CEO Hock Tan talked about 2 new incremental hyperscaler wins that weren't included in their forecast. On the contrary, we didn't see that from AMD, and we didn't see that from NVIDIA. So unless you're knocking the skin off the ball, I think a beat is a meet, and a meet is a miss. Meanwhile, Broadcom threw it out of the park with its latest quarterly results. The most important part of the report: the company expects strong AI semiconductor sales growth to continue. It sees AI semiconductor revenue of about $4.4 billion in fiscal Q2, which would be a 42% year-over-year growth. Broadcom reported $6 billion in free cash flow for the quarter. Its software business gross margin came in at about 90%. But what's Broadcom's moat? It makes ASIC chips designed for specific applications and tasks. As major companies look for custom chips to break NVIDIA monopoly and lower costs, Broadcom is positioned well to thrive. Many top AI spenders are teaming up with Broadcom to develop these chips, which are expected to be high-margin, high-volume products, potentially driving substantial growth in both revenue and profits. Broadcom Incorporated continues to be a leader in the AI, SCI, and networking chips market. Broadcom Inc. has 3nm AI ASIC chip deals with Alphabet and Meta, in addition to many other tech giants aiming massive spending for AI hyperscaling. The stock soared after the company reported quarterly results in December that defied expectations and further solidified the company's already compelling AI narrative. The technology infrastructure powerhouse with leading positions across wireless, data center networking, AI semiconductors, and infrastructure software reported strong results, including the usual prodigious cash flow generation, resulting in a double-digit increase to its dividend. More importantly, investors cheer the increased clarity concerning the company's AI market opportunity, now estimated at $60 to $90 billion by 2027, up from $15 to $20 billion in 2024. This sizable uptick and increased confidence provided by the management team about the AI opportunity drove a re-rating in the stock, and the company's market cap eclipsed $1 trillion in value. Overall, Broadcom stock ranks second on our list of tech stocks to buy now. While we acknowledge the potential of Broadcom, our conviction lies in the belief that under the radar, AI stocks hold greater promise for delivering higher returns and doing so within a shorter time frame. If you're looking for a tech stock that is more promising than Broadcom, but that trades at less than its earnings, check the next stock on the list. Remember to like, share, and subscribe to the channel so you don't miss the latest market opportunities. Moving on to the next undervalued stock to buy now, Lightspeed Commerce Incorporated, ticker LSPD. Lightspeed Commerce Incorporated engages in sale of cloud-based software subscriptions and payment solutions for single and multi-location retailers, restaurants, golf course operators, and other businesses in North America, Europe, the United Kingdom, Australia, New Zealand, and internationally. Its software platform enables customers to engage with consumers, manage operations, accept payments, and grow business. The company's cloud platform is designed around interrelated elements, such as omni-channel consumer experience, a comprehensive back-office operations management suite to improve customers' efficiency and insight, and the facilitation of payments. Its platform functionalities include full omni-channel capabilities, point-of-sale, POS, product and menu management, employee and inventory management comprising ordering, analytics and reporting, multi-location connectivity, order anywhere and curbside pickup functionality, loyalty, and customer management solutions. For investors hunting for undervalued stocks, Lightspeed might be too cheap to ignore. This cloud-based commerce platform has seen its stock take a hit due to ongoing macroeconomic uncertainties. Adding to the pressure, the company recently announced the conclusion of its strategic review, deciding to remain publicly traded rather than go private. This decision didn't sit well with the market, triggering a significant drop in share price. However, this decline presents a potential buying opportunity. This tech stock is now trading at historically low valuation levels with an NTM enterprise value to sales, NTM EV/sales, ratio of just 0.8 and a price-to-sales, PS ratio of 1.4, both marking multi-year lows. While the stock is trading cheap, Lightspeed remains well-positioned for long-term growth. The shift toward digital and multi-channel commerce provides a solid foundation for future growth. Moreover, its strategic acquisitions will accelerate its growth and customer base. Also, with a growing base of high-value customers and a focus on increasing average revenue per user, ARPU, the company is moving towards sustainable profitability, which will support its share price. So, we remain bullish with a buy opportunity on this stock. After looking deeply into these three high-potential technology stocks, do you think the opportunities are worth concern with the current economic and socio-political crises? Let us know in the comments section. However, for long-term investors, this might represent an opportunity to buy on the dip, anticipating a market rebound in the coming months. Do well too, like subscribe and turn on the bell notification for more analysis. See you in the next video.